going to say something that the financial establishment would rather you never hear. Not because it's reckless, but because it pulls the curtain back on a game most people don't even know they're playing. For the last 18 months, while ordinary investors were distracted by headlines, elections, interest rates, and whatever crisis the media wanted them focused on that week, the quiet money was moving. Not talking, not warning, moving. And the number that should stop you cold is 1.2 trillion. That is the estimated gap between the paper silver that has been sold, promised, leveraged, and traded across the financial system and the physical silver that actually exists in vaults. $1 trillion gap sitting underneath one of the most important industrial metals on Earth. And the people sitting closest to that gap are not panicking. They are positioning because when this breaks, and I believe it will, they do not want to be the ones holding promises. They want to be holding metal. So before you close this video, ask yourself one question. When the paper market breaks, which side will you be on? I have spent over 4 decades inside the machinery of global finance. I have sat across from central bankers, institutional traders, fund managers, and people whose decisions never make the evening news but still affect millions of lives. I saw warning signs before 2008. I watched institutions that everyone thought were too big, too connected, too protected to fail disappear almost overnight. Lehman Brothers, Bear Stearns, Washington Mutual, gone. I am not telling you this to impress you. I am telling you because when I look at the silver market today, the signals are louder than anything I have seen since the year before the last great financial unraveling. Most people still think silver is jewelry, a necklace, a coin, something shiny sitting in a drawer. That is exactly what they want you to think. Because silver is no longer just a precious metal. Silver is a strategic industrial weapon. Every electric vehicle uses silver. Every solar panel depends on silver. Every 5G network, advanced semiconductor, military system, medical device, and next-generation technology supply chain needs silver. And here is the part that should make every investor lean forward. Global demand has outpaced mining supply for 3 straight years, yet the price has barely reacted. Ask yourself the obvious question: how does an asset being consumed faster than it is produced stay cheap? The answer is paper. The price of silver is not being discovered by real supply and demand. It is being managed by futures contracts, derivatives, and promises. If a major institution wants to suppress the price, it does not need to dump real silver into the market. It can dump paper silver, contracts, claims, synthetic supply. When enough paper hits the market, the illusion of abundance keeps the price down. And that is where the danger begins. If even a small percentage of people holding paper silver demanded the actual metal, the vaults could be drained fast. Not months, not years, fast. We have seen this kind of thing before. In 1980, the Hunt brothers helped drive silver from around $6 to nearly $50 an ounce. Then in a single weekend, the rules changed. The exchanges restricted buying, silver collapsed, and the Hunts were destroyed. Most people tell that story as a warning about greed. I see it differently. The real lesson is that when silver threatens the system changes the rules. But this time, it is not 2 Texas billionaires. This time, it is sovereign buyers, industrial demand, China, India, Russia, central banks, institutions, and millions of people who no longer trust paper promises. The Hunt brothers had billions. Today's players have trillions. And the paper wall holding silver down is beginning to crack. Now think about the average family. A middle-class household with a mortgage, 2 kids, retirement savings, and maybe $60,000 set aside. They hear about silver, they go online, and they buy a silver ETF. They feel protected. They tell themselves, we own silver. But do they? In most cases, no. They own exposure. They own a claim. They own a promise made by an institution that may be leveraged, may have lent metal, may be relying on custodians, sub-custodians, counterparties, and legal language buried deep in a prospectus most people will never read. In a calm market, that distinction feels academic. In a crisis, it becomes everything. In 2008, people thought their assets were segregated, protected, and safe. Then accounts froze. Bankruptcy courts got involved. Counterparty risk went from theoretical to catastrophic. That is what paper silver investors are not being told. You do not want to discover the difference between owning silver and owning a promise for silver on the morning everyone else discovers it too. And the trigger may not even come from the silver market itself. It could come from a bank, a hedge fund, a sovereign buyer, a regulatory shift, a geopolitical shock, a delivery failure. One major player says, "We want the metal." The exchange cannot fully deliver. Word spreads. Suddenly, everyone wants delivery. And the same paper system that made silver look abundant reveals the truth. There is not enough physical metal to satisfy all the claims. That is when prices do not rise politely. They gap. They explode. They move in a way that ordinary investors are not psychologically prepared for. Physical silver holders may wake up to numbers they do not believe. Paper silver holders may wake up to redemption delays, legal language, frozen exits, and explanations that arrive too late to matter. This is why the first step is brutally simple. Know what you own. If your silver exposure is an ETF, a certificate, a pool account, or any paper product, read the prospectus, not the marketing page, the prospectus. Look for the language about extraordinary market conditions, delivery limits, redemption restrictions, custodians, and risk. Because every crisis is an extraordinary market condition. That is the whole point. The moment you most need liquidity is the exact moment the fine print matters most. The second step is owning the right kind of physical silver. Not all silver is equal in a crisis. You want metal that is recognized, trusted, and liquid. American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics. Recognize 100-ounce bars from approved refiners, silver that dealers understand immediately. Obscure rounds, collector coins, numismatic pieces, and strange foreign products may look attractive in normal times, but when markets get chaotic, liquidity matters more than novelty. You do not want to be explaining what you own while prices are moving and buyers are nervous. The third step is position sizing. This is where smart people make dumb mistakes. They are right about the macro setup, but they either buy too little to matter or so much that the first violent pullback shakes them out. Silver does not move gently. It surges, drops, punishes weak hands, then surges again. If you cannot handle volatility, you will sell at the wrong time. Discipline is the entire game. You need enough exposure to benefit if the thesis plays out, but not so much that fear controls your decisions. And then there is the regulatory pressure building underneath all of this. Basel III is changing how banks think about unallocated metal exposure. Paper claims are becoming more expensive to carry. When banks are pushed to reduce paper exposure, the suppressive weight on silver begins to weaken. At the same time, industrial demand keeps growing. Mine supply remains constrained, and major powers are shifting away from dollar dependence. Put those forces together, and you do not have a normal commodity setup. You have a pressure cooker. Some analysts believe silver's real price, without paper suppression, could be multiples higher than where it trades today. Whether that number is $80, $150, or $300 is not the point. The point is that silver may be one of the most mispriced strategic assets in the world. And when mispriced strategic assets finally reprice, they do not send calendar invites. They move while most people are still debating whether the warning signs were real. This is the part one want you to hear clearly. Ordinary people are not failing because they are stupid. They are failing because they are given incomplete information, packaged products, comforting narratives, and the illusion that institutions will protect them. But institutions protect themselves first. Always have, always will. The wealthy understand this. They do not store generational wealth only in cash. They own land, businesses, commodities, productive assets, hard assets, things the system cannot print into existence. Silver sits at the intersection of monetary protection, industrial demand, and geopolitical strategy. That combination is rare. And the window where ordinary people can still acquire it before the crowd wakes up will not stay open forever. So here is what I would do. First, audit your exposure. Know whether you own silver or a promise. Second, focus on liquid, recognizable physical silver. Third, size the position intelligently so you can survive the volatility. Because in markets like this, the people who prepare early are the ones who still have choices later. Thanks for watching. Have a wonderful day.